Hello, everyone. I'm Katie Kalmahi-Eva with Sterling Seacrest Pritchard. Thank you for joining us today. So Sterling Seacrest Pritchard is a risk management and insurance brokerage firm serving the commercial, professional, and personal needs of clients across a range of industries. We offer all forms of property and casualty insurance, employee benefits, and surety bonds. We provide free educational programs to our clients and network each month, and we are excited about our program today, how the new lease standard ASC 842 impacts financial statements and financial ratios. And we have three speakers joining us from Colson CPAs and Advisors. First, I'm going to introduce Stephen Bailey. He is a partner in Colson's business assurance practice. He leads audit and assurance engagements primarily with the construction, transportation, software, technology, and healthcare industries. Stephen has also been involved in providing transaction advisory services associated with mergers and acquisitions. Next, we have Daryl Kent. He's a director in Colson's business assurance practice. Daryl provides technical accounting support and consulting to a variety of public and private companies in the construction, manufacturing, and distribution industries. He also leads employee benefit plan audits. And next we have Brendan Adams. He's a senior manager in Colson's business assurance practice. Brendan is responsible for planning and overseeing all aspects of financial statement audits and reviews and leads employee benefit plan audits with a focus in the construction and manufacturing industries. We'd like to hold questions until the end of the presentation, but we would love to hear from you. If you have any questions or comments, please feel free to submit them using the Q&A chat feature. We're going to monitor that chat throughout the program, and please keep yourself muted unless asking a question at the end of the presentation, please. All right, everyone, please welcome Daryl Kent to kick us off.
Thanks, Katie, and thanks everyone for joining us this morning. So ASC 842 really is the biggest change in the accounting profession we've had. In the last few years, we got through ASC 606, which was the revenue recognition, and then immediately jumped into ASC 842 related to leases. So we're going to go through a few topics today. The first one being the big picture, just kind of what's changed from a high level, what's new, what's out there, how is this impacting financial statements. Brendan's going to go through some key assumptions and considerations to think through as you're making these calculations and these journal entries. Also, they've put some new recent guidance, I think it was effective in March, related to related party and common control arrangements. A lot of times, especially when you're dealing with large family-owned businesses, you'll have different entities and leases in between entities. And so the FASB's put some guidance out related for private companies that allows them to kind of scope themselves out or make this a little bit easier than it would be. Finally, we'll look at the financial statement impact. So what is this doing to your financial statements as you're going through and preparing them, as you're providing them to third parties? What kind of impact does this have? What kind of questions do you need to be ready for? We're also going to go through just an example financial statement that'll show you some of the changes to your balance sheet. We'll also show you some of the changes to the notes. And then finally, if there's any questions out there, like Katie mentioned, Stephen is going to be monitoring the chat, and then we'll have some time for Q&A afterwards. So let's start with the big picture. So the big picture on this is really related to the biggest change is really related to operating leases. So historically, your operating leases would have been an off-balance sheet, and you would have just had a financial statement disclosure in the back of the financial statements that disclosed, normally disclosed when the leases were up, and then you'd also disclose your payments on those leases. Finance leases or capital leases have always been on the balance sheet of the financial statements, and what we're doing with this is really it's just more of a change in naming convention. So when you pull these leases on your balance sheet now, you're going to have what's called a right of use asset. We'll use the nomenclature ROU throughout this presentation. So an ROU asset and a lease liability. And really what that's doing is it's grossing up your balance sheet to show that you've got an asset related to this lease. You've got the right to use this asset, a contractual right to use this, whatever it is, piece of equipment, building. And so we're going to assign a value to that. And then you've also got a contractual liability to make payments on that. The idea is this is more transparent instead of these amounts just being, especially in the case of an operating lease, instead of these amounts being buried in the back of the financial statement, now they're on the face of the balance sheet for your users to see. There is so this was, you'll see at the bottom here, this was effective beginning after December 15th, 2021. So, really this should have been adopted by entities who are issuing GAAP financial statements January 1, 2022, if you're on a calendar year end. We've got a few clients that have off year end. So if it's a 9/30 year end, 10/31, whatever it might be, you might not have issued financial statements yet with this in there. So this is something that you need to be thinking about. When they issued this, and really what they want you to do is go back and not only look at like a document that has lease at the top, but other agreements you've got. And is there a contractual right for enforcement in these that would be lease-like? Obviously, for private companies, that could be a huge lift. So one of the things that the FASB put out was a practical expedient at adoption. We refer to it here as the package of three. You have to look at, if you adopt this, you adopt all three. You can't pick and choose which ones you want to adopt, but it does offer some relief. So the first thing you're not required to do is reassess your initial direct cost, like you would if you had a lease coming on for the first time, say during 2022. You also don't have to reassess your lease classification. So if you've historically accounted for something as an operating lease, whether that was right or wrong, whether it should have been a finance lease, a capital lease, or an operating lease, you can stick with what you've historically done. And you also don't have to go back into contracts and reassess whether they potentially contain a lease, or if a lease is expired, you don't have to go back and reassess the impact of that under 842. So this offers a really nice way for private companies to not be overburdened by this adoption. The other thing that the standard leaves alone is for leases that are less than 12 months. So a short-term lease, these are not required. These are not accounted for under ASC 842. So you would not have an ROU asset or a lease liability associated with that lease. And then the biggest change is going to be determining the calculation, determining your discount rate. And so the way that you calculate this is the present value of your lease payments over the lease term using the appropriate discount rate. There's a lot of judgment that's involved in both of these things. The first being the lease term. What is the lease term? How do you factor in renewal periods? And then also determining what your discount rate is. And Brendan will go through these in a little bit more detail. But as you're thinking through this, as you're thinking about the contracts that your company has, this is all stuff that you need to make sure are on your radar and you're analyzing as you go through this adoption. And then flip over to the next slide. So the biggest change on this is obviously going to be to your balance sheet, specifically related to your operating leases. Your expense recognition, for the most part, isn't going to change. You're still going to recognize expense over straight line, just like you would do historically for operating leases. You would have straight lined your rent payments, divided it over the lease term, and recognize that ratably on a monthly or annual basis. You're still going to end up in the same spot for operating lease expense on those. And then the change in the finance leases is you are going to have a higher lease cost in your earlier periods because you're going to have more interest associated with that lease. You now kind of thinking about that lease liability like you would a loan. And so just like on a mortgage, you pay more interest in the beginning, you pay less interest, you pay more principal at the back end. It's going to be the same thing under 842 in these finance leases. The last thing is the transition period. There's two methods here. So comparative. So you could go back, and if you're still in the process of issuing your 2022 financial statements, you could go back and issue this for 2021 so that you would have, truly comparative financial statements. Again, you would have to do all the same calculations and methodology changes in 2021. Or you can do this as of the effective of the adoption date. We'll run through a little bit of what that would look like in your financial statements. I think personally, we've been advising our clients to just adopt it as of the effective date. So if the effective date for your company is January 1, 2022, we would just change 2022 financial statements. 2021 would still have the same nomenclature, would still all look the same. There would be some additional disclosure related to 2022 that would go along with it. And then obviously, as you roll into 2023, you would have 2022 and 2023 financial statements that look the same with the right of use asset and right of use liabilities. The other thing that we want to clarify before we get started is public business entity. We'll refer to it as a PBE. So think of these really, we've got the formal definition here, but think of these as your public businesses that trade on a stock exchange, whether S&P 500, NASDAQ. There are certain things under this standard. The first being that they had to adopt this before it was effective for them prior to December 15th, 2021. So they had to adopt it prior to that. And then there's some of these practical expedients when we talk about the related party and common control stuff. There's certain things that these entities will not qualify for. So if you see PBE throughout this presentation, it refers to public business entity. Looking at the list of people who I believe are on this, I didn't see any public business entities. So your entities would more than likely qualify for kind of the private company accounting for this. So that, Brendan, do you want to take us through some of the key assumptions and considerations?
Yeah, appreciate it, Daryl. So he went through a couple of terms that we tried to highlight or bold for you in the overview tab, but one of them was the discount rate, and Daryl alluded to that earlier. But when we say discount rate, 842 defines that as the implicit rate in the lease agreement, if it's available. And if it is available, you have to use that when discounting the lease payments to present value. And so we see that a lot with a lot of car leases. You can derive the implicit rate, but for your real estate leases, they're not always as straightforward. And so you ask the question, well, what if it's not defined in the agreement? What if the implicit rate is not available? Well, then you move on to what is your incremental borrowing rate? And essentially what that is, it's the rate that you would get on a collateralized basis to purchase a similar asset, essentially. And so that's where judgment comes into play. And it's an assumption made by management. If you've got a line of credit, if you've got debt with a bank that's existing, you can sometimes default to that. But if you're getting into that area where you're trying to determine what your incremental borrowing rate is, consult with your CPAs, get their thoughts. One option for non-public entities, however, I guess it's the easy option, is there's a practical expedient that allows you to use the risk-free rate. And depending on where rates are, that might make sense. Now, just keep in mind that as with higher rates, and rates have started to move up, within the last year, a higher rate would result in a higher discount. So you'd be putting on a right of use asset and a lease liability that would be smaller than which you would put on the balance sheet had you discounted it using a lower rate. So when you're thinking about using the risk-free rate versus your incremental borrowing rate, it may not matter, but for some it might, because one of the things with 842 is that the ROU asset goes on long term on your balance sheet, but for the liability side, there is a short-term portion. And so that short-term piece is what's going to hit you on your working capital. And so if you've got covenants, if you monitor your working capital pretty closely, one thing you're going to now need to consider and factor in is the short-term liability applicable to these operating leases that have never been on the balance sheet until now. And so just one thing to consider there when you're trying to determine what discount rate to use. One new thing too for 842 is renewal options, and renewal options have always been in these lease agreements, but under 842, this is the first time we've had to actually consider and factor them in when determining what the total lease term is at the inception of a lease. So pre 842, we just kind of disregarded them. But now under 842, if there is a renewal option, and most of the times there is, especially on these building leases, what 842 says is, well, you need to determine when you get to the end of the initial term, are you reasonably certain to exercise that renewal option? And this is another area that requires management judgment, and there's certain factors that you would need to consider, and that 842, if you read the fine print, there's certain things you need to kind of think through as you're evaluating whether or not you're reasonably certain to exercise a renewal option. In some cases, there might be multiple renewal options. Couple of the main items to consider are cost to relocate. So how easy would it be for your company to pick up and move to another location? Do you have significant leasehold improvements that you've invested in over the years? If so, and let's just say it's not easy to just pick up and relocate, you would incur significant moving expenses. It'd be a heavy burden to just pick up and move all your equipment, your employees to a new location. Well, that might be an area where you probably are reasonably certain to exercise potentially. Again, it's judgment. There's certain things to think through, but this is the first time that you as CFOs and as management have had to walk through these questions as it relates to your leases. So if you're not sure, talk with your CPA. You can talk with us. We can give you our thoughts and recommendations. But just that's one new thing this year that we've had to work through. Options to purchase, those have always been there too. Think of your bargain purchase options. If you get to the end of the lease, you have a buyout for $1 or whatever it is. In that case, you're probably reasonably certain to exercise that. But just something else to think through in another area that requires your judgment. But we're happy to offer our thoughts on that. So Brendan, if you do have an option to purchase. Yes,
what have you been advising your clients as I know it's not a bright line test, but reasonably certain? What if we're going to say it's on or about, what percentage certain do you think you have to be before you kind of get to that reasonably certain threshold?
So I think there may be some guidance on that. I think, and correct me if I'm wrong if you've heard otherwise, Stephen. I think there's I don't know if there's I think 75% is like what I've heard. Now you have to determine what 75%, like when do you get to that point, right? So it's like, it's a tough area. I would say if I had a client that said, hey, I don't know where I'd go. I don't want to look. I don't want to pay for the moving expenses. And oh, by the way, we've got a few $100,000 of leasehold that we've invested and purchased over the years. Probably say, why would you move then, right?
Right.
And then I'd say you're probably likely to exercise. But again, there's other scenarios where for example, if it's a 10-year time horizon, right, and maybe you're looking to go public, or you're looking to sell, or you're looking to, you've got some type of, plan to sell your business. Well, in 10 years, a lot could happen, right? So even if you had significant leasehold improvements, even if you had significant, if you think it would cost you a lot to move, for a 10-year time horizon, I would argue there's a lot that could happen, right? And so there's a give and take there.
Yeah, and I think this is something that needs to be assessed annually as well, right? So it might be if you've got a 10-year lease, you're not reasonably certain in years 1, 2, 3, 4, 5, 6, but all of a sudden you get to year 7, year 8, and you are reasonably certain to exercise, then you would do a lease modification, right? And pick up some of that additional cost.
Yeah, and on that point, because the question I can already see is, well, what happens if we say that we're not reasonably certain, but then we do, new information comes to light. Now we are 5 years down the road. He mentioned a modification. Well, generally speaking, a modification, you would just reevaluate the liability, at the modification date. So at the date that you determine, okay, yes, we are now reasonably certain, you don't go back and have to restate prior periods. You would just account for that modification on a prospective basis. So you're not setting yourself up for failure. You're just using the information at the time, and now you have new information down the road. Count for it on a prospective basis. So just wanted to make that clear. But as far as what triggers that, again, there's a give and take. It's ultimately your decision, but we can offer some kind of things to think through if you do have to and make that determination. He mentioned initial indirect costs as well. Think of like, I see it with these car leases. You usually at the the date that you execute the agreement, you've got taxes, fees, other minimal upfront payments. Technically you're supposed to include those with the ROU asset and amortize those over the life of the lease. For amounts that are minimal or not material, as we would define it, whether you want to expense that or include it with the RU asset, there's depending on the situation, we may or may not care. But for significant initial direct costs that are material, whether that's by our definition or yours, you should technically tack that on to the ROU asset at lease inception and recognize that expense over the term. Lease incentives. This is another common thing we see in the your typical building arrangements. I feel like I see it more often than not now, where the lessor, as in the negotiation process to entice you to execute a lease with them, they'll offer a tenant improvement allowance is typically what we see, or how it's defined. So if it does qualify as a tenant improvement allowance, where the lessor is basically giving you a stated allowance, and usually there is a cap. It'll say something like, you sign the lease, but we'll pay for $500,000 in improvements, if you're willing to sign the agreement. So that's defined as an incentive, and what 842 says is technically you should reduce your lease liability. And so if you think about how you calculate your liability, you're looking at the total lease payments over the term, and then you're going to discount that back, right? Well, you're going to reduce that calculation, the present value of your future required payments, by this improvement allowance at inception. And again, there's some conversation to be had, whether it's an allowance or a reimbursement. Who owns the improvements is a big question here. So if you've got an improvement allowance, or that's written up as an improvement allowance, but really you don't really control anything related to it. It's general improvements. It's not really designed for you. Technically you could argue those are really lesser improvements, not yours. And so, if you get into that situation, I would say just talk to your CPA, talk to us, because what we've heard recently is that there's some diversity in practice on these lease incentives and tenant improvements, and who owns those improvements. And depending on who owns them, whether it's the lessor or the lessee, that'll impact the accounting for your leases. So just one thing to consider there. Lease commencement. Now 842 defines that as you don't start on the date that you sign the agreement. You could sign the agreement on X date, but it's really all about when did it become available for you? Okay, when were you able to move in? When did you get the keys? When were you able to start making any lessee improvements to the property, right? So that may or may not be the date that you signed the agreement, but 842 would ask you to use the date that the property or the asset became available for use by you, and technically that is the lease commencement date. Which may or may not align with the date of the agreement. So back to our lease term. So the starting point is you take your agreement and you go to the lease term section, and whatever is stated in there, whether it's 3 years, 5 years, 30 years, that's your starting point. Okay, and that's pretty clear. That's always going to be stated in the agreement. Okay, so you take your starting point, and then we talked about renewal options. Okay, and so this second line item here is referring to those renewal options. All right, if you walk through your your assumptions and checklist, when you get to the point of determining that you are or are not reasonably certain. Now, again, there's certain factors to consider. If you determine that yes, you are reasonably certain to exercise that renewal option, then that is added to the stated period in the lease agreement. So initial term 5 years, there's a renewal option for 5 years. At the end of the initial term, you say, yes, I'm reasonably certain to exercise that. Well, your lease term is 10 years at lease inception. Okay. And then these other two line items are less common, but it relates to options to terminate or extend leases, and whether or not you have the power to terminate them. But I would say that line item number 2 is the one that we are seeing in practice almost all the time, especially for these building leases. Okay, so this is a good slide that kind of highlights the differences between 842 and 840. So pre-842. A lot of it's the same. Two key differences is, this is kind of the questions that you have to walk through to determine whether or not it's an operating or finance lease. For the most part, they're essentially the same. A couple tweaks here is 842 has removed the 75% test and the 90% test as it relates to your lease term and the present value of the payments. So before 842, if your lease term it was 75% or more of the useful life of the asset, well, that was a clear indication that it's a finance lease. On the present value side, if the present value of the minimum payments was at least 90% of the fair value of the asset, that's a finance lease. Well, those bright lines have been removed. Okay, there is no 75% test. There is no 90% test. Back to management judgment. Okay, I think most people are likely still using those thresholds as a guide, and I don't see why you wouldn't. Probably would advise you to do that. But in the fine print, just know there are no bright lines. One new item here, though, is they've added the specialized asset determination. So that's that fifth box there on the right, and this is new to 842. So if you've got an asset that is so specialized or customized for you, and there's no alternative use to the lessor at the end of the lease, well, it's really your asset. I mean, even if it's written up as an operating lease, in substance, it's so customized for you that the lessor can't turn around and lease it to anyone else at the end of the term. That's a finance lease, and so that is one new clarification item that they added under 842. I wanted to back up. Daryl, Stephen, anything to add here? I think I'm at the end of the assumptions and considerations, but did I miss anything high level or anything to add on that?
No, I think you covered it pretty well, Brendan. And I think, what I'm hearing over several of these slides and what the audience needs to hear is there's a lot of judgment and the guidance now, which can be a blessing and a curse, right? The FASB wanted to provide that avenue for more judgment at the company level. But maybe I don't speak for everyone. I love having some bright line tests from time to time that kind of make that decision process easier. But whether you're talking about, this analysis of finance versus operating, or, going back to the lease term, the discount rate, all these assumptions that go into the calculation of the ROU asset and lease liability. Again, there's judgment in the guidance that can provide, I don't want to say leeway, but if these assumptions are supportable, certainly a lot more ability to have that, be more fluid in practice and let companies take more ownership over the economics of what their numbers are telling them versus having some rigid set of rules guide that for you.
Yes, I'm gonna hand it off to Daryl, and this is one thing we were all excited about, and I think you'll be excited about too. Is there was some new guidance related to common control arrangements, which I would imagine is likely applicable to a lot of the audience here. So Daryl, you want to take it from here?
Yeah, thanks, Brendan. I don't know how familiar everyone is on the call, but there's the people who refer to as the PCC, the Private Company Council. And this is a group that really are advisors to the FASB board, and they are really looking out for, I don't want to say the little guy, but the non-SEC clients. A lot of GAAP, a lot of FASB standards and updates are geared towards, large publicly held companies. And sometimes the rules can be difficult and onerous for private companies to implement. There's a difference between a private company accounting department and a public company accounting department that's got specialists and everybody under the sun, under the umbrella. It's just not feasible, and it's not economical in the private company setting. And so the private company council is out there to look out for the non-public companies. Again, this is where to adopt this stuff is it's important that you understand you have to be a non-public business entity, which is the definition that we looked at previously. And I think the slides will go out, so you'll have that to look at to determine if you qualify. But the Private Company Council, they've done things like allow you to amortize goodwill over 10 years and subsume some intangible assets into goodwill instead of having to separately value that stuff and business combinations. They've issued some guidance on VIEs and not having to consolidate, VIEs that are under potential VIEs that are under common control. And, really, I think this guidance, in my mind, kind of piggybacks off that VIE guidance a little bit. And so under 840, when we were looking at related party leases, we looked at the economic substance of the lease. And so that would help us determine whether it was operating or capital. And then when 842 came out, there was this concept of legally enforceable, which is great because, we're not attorneys, we're accountants. And so how do we determine what is legally enforceable, and was, almost to a certain extent kind of boxing us, and it does box us into this, legal definition and legal enforceability, which is not our expertise, right? Some people, you might have some accountants who are attorneys. I'm not one. Sometimes that makes us a little uncomfortable. But what this did is it allows us to remove that legal enforceability concept and focus on what is written in the agreement. And this is where it's important where if you've got related party leases, you've got an entity that holds land and sits off to the side, and maybe you're not reporting, your operating company doesn't consolidate that entity. The but the operating company leases land or a building from that entity. And maybe you don't have a written document, and this is where it becomes important to have that written document, because we're going to go off what's written in the document. And if there's nothing written down, then we're back into this concept of legal enforceability. So, if you don't have, if you want to be able to control how big of an impact, or have more control over how big of an impact 842 has at the level that you're issuing financial statements, having those written documents is important, because it's going to allow you to control what your lease term is, control purchase options, early termination periods, all that kind of stuff, as long as it's written in the document. If it's not written in the document, then again, we're back into this, use our judgment to determine what's legally enforceable, how long are we likely to stay, or reasonably certain to stay here for our lease term, and all this kind of stuff. And so a written document here can save you a lot of time and a lot of effort and a lot of judgment, because you're allowed to just go off what's written in the agreement. I mean, candidly, I've had some clients that have said, well, hey, this is what's in the agreement. I'm going to make this a short-term lease. And then they'll just re-sign a lease every year. Or, I'm going to make my lease payments, structure them in such a way that it's tied to something that attended some variable consideration that scopes it out of 842. And so that they're able to keep some of this. There's still disclosures that go along with it, but it keeps some of this off the balance sheet and back where it was in the notes. And so this, I think, is it's been a great relief for a lot of our clients, in just allowing them to structure these things, giving them more control over how these leases are structured, how they end up impacting the financial statements. And if you flip to the next slide, Brendan, what we've done here is kind of laid out. These are a lot of ratios that businesses use internally. This is ratios that you'll see in debt covenants, and how this new lease standard impacts those. And what you'll see here is you'll see things like the current ratio, it decreases, the quick ratio, it decreases, the working capital ratio, it decreases. And Brendan talked about this earlier, that what happens is you end up with an asset that's basically equivalent to a fixed asset, sits in long-term on your balance sheet, long-term assets on your balance sheet. And then you've got this current portion of the liability, which for argument's sake is roughly equal to 12 months worth of payments. And so it creates this imbalance that's never been there. And so if you're a construction company and you're working with your bonding, you fire over a set of financial statements to your bonding entities and sureties, and they all of a sudden your working cap has taken a hit because you've got this new liability that wasn't there previously, and it's going to make the working cap lower than what they've historically seen. And so making sure that they've got the understanding of what's playing into that, hey, this was always there. It was just not required to be on the balance sheet, and now it is. The other thing is you've got you might have some debt agreements that were written with certain covenants when the old 840 was in effect. And so all of a sudden 842 is now in effect, and you go from passing debt covenants to failing debt covenants, and making sure that you can have that discussion with your bank and determine whether maybe we need to rewrite the debt covenants to something that now makes sense based on the financial statement presentation. Maybe we need to clarify in the debt covenant that the debt covenant is calculated based off of the gap that was in effect when the agreement was signed. Banks weren't factoring in the impact that 842 would have when they were writing debt covenants 2, 3, 4 years ago. A lot of that reads just, based on, it'll just say something like US GAAP. generally accounting principles generally accepted in the United States of America, something like that. And so it's pointing you back to GAAP. Well, now GAAP, as of January 1, 2022, for most companies includes 842. When that covenant was written, when that language was written, it didn't cover the impact that this would have. And so now all of a sudden you're in a situation where, really fundamentally nothing's changed about your business. You're still making the same amount of money. You still got the same cash outflows, but now it looks like when you pass along your financial statements to your bank that something is changed, because all of a sudden your covenants, you're no longer passing those. So anything that really has to do with assets, you're going to have greater overall assets, just not greater current assets. And you're going to have greater liabilities and greater current liabilities. And that's where a lot of people, where we've seen a lot of issues, is they've got this, all of a sudden they've got this current liability that historically hadn't been there, and it's throwing something off. And, whether it's your debt to equity or your working cap or all these covenants that are now being impacted that hadn't been contemplated because the covenant was written prior to 842 becoming effective. And you'll see that, I think, Brendan, we've got a couple of financial statements here, right, that we'll go through, and you'll see what I'm talking about. It's easier to visualize it, I think, on the face of the financial statement versus just looking at these ratios. The other thing on this is the tax impact is minimal. There's an M1 adjustment because a lot of this is, we've alluded to it, is like there's no impact to your cash payments on your leases, right? A lot of the book changes are all non-cash differences. So for tax, you're still going to be in the same position of recognizing the expense when you make the cash payment. But you might have a new M1 adjustment that shows up that wasn't historically there when you're looking at your tax returns. So Brendan, do you want to run through the financial statements, and then after that we can open it up to the group for comments or questions?
Yeah, that sounds good. So if you have implemented 842, or you're planning to implement, whether you've got reviewed financials or whatever your requirement is, if there is one, hopefully they look something similar to this. And so really what we've tried to do is taken a set of financials and tried to highlight the new line items here on the balance sheet. And so in this case, we had, I believe it was a building lease, just one building lease. And you can see, as Daryl mentioned, the ROU asset, the operating lease right of use asset, goes up on the balance sheet under the long-term section. And then down below in your liabilities, you can see the breakout between the current and the long-term piece. So those are the three new line items. If you've got finance leases in addition to operating, those would be broken out separately. Okay, we would not want to net those on the balance sheet. Okay. This is our income statement, and for an operating lease, again, we've tried to bring in a simple example. So one lease, one operating lease. Again, we're bringing them on the balance sheet, but the P&L impact there's essentially no impact. What you recognized as expense last year, assuming no changes, would be the same expense you'd recognize this year. You're going to straight line expense, the total payments over the lease term. And so when we say straight line, what we mean is, a lot of these building leases have escalating payments. So they've got a set schedule and those payments are escalating, I don't know, maybe 3% per year. Well, under 842 and even pre-842, that's not the expense we'd recognize each year. We would take those total payments and divide it by the lease term, and we'd recognize a uniform expense for these operating leases. And that's no different under 842. And so our rent expense is just going to sit in your SG&A, okay, and that's in contrast to the finance leases, which we'll get to. Instead of the expense sitting in your rent expense under the finance leases, you'd have an interest portion. So there is no interest portion on the operating leases. the straight line expense all falls under your rent expense. Okay. So don't let that confuse you when you see a cash flow statement that has either a non-cash reduction, or sometimes we'll call it, amortization of the ROU asset. For an operating lease, you're not going to have an amortization expense. Okay, that amortization expense is really sitting in your rent expense, or at least it should be. Okay, we don't break out rent expense, amortization expense on the income statement for operating leases. Okay. The cash flow is a little confusing. I'll concede that. So what I've tried to do, and we don't need to go through this now, but you can use this as a reference. And I've tried to show you how these line items on the cash flow statement, and again, this is specific for an operating lease, how they tie back to your note disclosures. Okay. And so really what you do is you start with your cash payments. Okay. And then you add in the amortization or the non-cash reduction of your ROU asset, and then you further net that with your reduction in the lease liability, and that should get you to your straight line expense. Okay, so it's a little wonky. It can be confusing, but I've tried to show you how these amounts tie back to your notes. But long story short, for operating leases, yes, they're on the balance sheet now, but no, there should be no P&L impact. Your expense last year should be the same expense you recognize this year, assuming no changes to the lease. And
Brendan,
this is just, yeah.
That's one thing. Go back to the balance sheet that I wanted to point out here. If you've had escalating rent payments under an operating lease, you would be used to seeing like a deferred rent amount hanging out as a current liability. You'll now notice that it's gone. That's no longer there. And that really is factored into your lease liability when that calculation's done. So you shouldn't see that nomenclature used in the balance sheet anymore once 842 has been adopted.
Yeah. So just to add to that, the deferred rent liability that was pre-842, that was your way of straight lining the rent expense. Well, now your method of straight lining the rent expense is being done via the amortization and the reduction of these ROU assets and lease liabilities. So the method hasn't changed. It's just the mechanics of how we get there, and the presentation has changed. So that was thank you for adding that, Daryl. This is a standard disclosure, basically in the adoption year. So in the year of adoption, and for our clients, it was generally 2022, because they required to adopt by 1/1/22. And so this is the typical generic standard disclosure, if you will, that basically highlights what 842 is and what's changed, and some of the practical expedients that Daryl mentioned earlier. But I've tried to highlight some of the key terms that we've already discussed. Modified retrospective transition method. He mentioned the package of 3 earlier, which I would highly recommend making sure you adopt that and disclose that. I can't see any reason why you wouldn't. And then the renewal options and the lease terms, we've highlighted those there because those have changed, right? The definitions and the agreements haven't changed, but the assumptions and the factors that we have to consider have changed as it relates to your lease term, commencement date. All these terms we've already talked about. So hopefully this is something you've seen if you have adopted, or at least hopefully it's not too far off. But and then getting into the details. So the disclosures for operating leases, you've always had the information. The information about these operating leases have always been disclosed. Okay, you've always had the 5-year payment schedule. You've always disclosed your total rent expense and where it is. Generally in SG&A, maybe a combination of SG&A and cost. But I'll call these are the new and improved enhanced disclosures under 842. So we've got our typical 5-year payment schedule, but then down below in that second section there, that's kind of the new enhanced additional disclosures that were required to include under 842. So operating cash flows, what that is your actual payments. Those are the payments you made per the terms of the agreement, okay, you know, for this year. And in this case, this would be a 2022 year. And the expense, okay, is not necessarily what the cash flows are, because this in this agreement there are escalating rents. And so you can see we've highlighted the expense piece there to the tune of $659,000. All right. And so your expense, the delta between your expense and your actual cash flows, that's what we typically refer to as your non-cash expense. Okay. Your straight line expense would be the $659,000 there. So, and then we just disclose a weighted average remaining lease term. And then in this case, they used their incremental borrowing rate, which we determined to be 4.87%. And so really just some new disclosures. Again, the future payments have always been there. The only difference is now we may have more future payments, because we're now required to evaluate and bring in more lease terms, again, if we're reasonably certain to exercise those. So that's really what you should be seeing for your new disclosures. You know, this is a simple example. You know, this is just an operating lease, and you could have a combination of operating and finance, and then it gets a little, you know, it can get a little, you know, there'd be some more disclosures related to the finance side. But this is a simple disclosure. Daryl, Stephen, anything else you want to point out there before we flip to a finance example?
No.
Nope.
I think you got it all.
Okay. So another simple example, you know, one lease, except for in this case, it's a finance lease, and nothing really different as compared to the operating lease as it relates to the balance sheet, except for we're clearly defining it as a finance lease asset versus operating lease. And again, if we had operating leases, we would want to show those separately on the balance sheet. Here's the income statement. So this is a little different. You know, kind of mentioned it earlier, but there is an interest portion to these finance leases, okay? And that is not going to sit in rent expense, okay? That will be broken out separately. You know, we'll call it below the line, below your operating income. The amortization of the RU asset will still stay up in SG&A, but, you know, with your finance leases, if they're significant, you know, it could impact, depending on what metrics you're using or others are using to evaluate, you know, your operations. You know, this is one thing that could have an impact. The fact that we've got a piece of this that's above and then a piece that's below your operating income. So that's the key difference with finance leases. And I'm going to show you some disclosures that are going to go into more detail on how we get to the interest expense in just a second. Here's the cash flow statement. In this case, we do have an amortization piece for the finance lease assets. And one thing that's different here is under your investing activities, your payments made to acquire. So, you know, if you had to make a payment up front to acquire an asset, that's really an initial direct cost, which should go into your investing section. Similar if you had purchased a fixed asset outright, you know, kind of similar theory there. And then the principal repayments, so the actual reductions of the liability, your lease liability, which is not your total cash payments, but the principal portion of your cash payments is what will sit there in your financing section. So tried to highlight those for you. We'll get into some details here. This is another standard disclosure. Only difference is it's a little watered down because in this case they early adopted, and so this was the year after adoption. So the disclosures are similar, but we don't go into so much the same disclosures that we would in the year one or in the adoption year. So similar setup here as the operating lease disclosure. A couple differences here though. We've got the amortization piece and the interest piece broken out separately under your finance lease costs to get to your total finance lease expense. Just keeping in mind that a piece of that's going to sit up in SG&A, and then another piece of it, the interest portion, is going to sit down below the line, below your operating profit. Is again, just wanted to continue to point that out. And then I've boxed off some of the amounts that we already went through on the cash flow statement. You can see how those tick and tie back and forth. But again, one other change I wanted to mention just real quick. This is, in this case, we were in the second year, so we adopted the previous year. The $427,000 right there, that would have been a new lease that we put on the balance sheet in the current year. So that's not the amount that we adopted. That's the amount of new leases that we added to the balance sheet post adoption in the year two. And then the same disclosures related to the lease term and the discount rate. But that's really it for the disclosures. So hopefully y'all have seen something similar. You know, some of the verbiage and some of the words may be slightly different, but the overall content should be something similar. And that brings us to the end. Hopefully that kind of affirms some things you already knew or were hearing as it relates to some of the definitions and the assumptions and the financials. But happy to open the floor to any questions, comments, observations from your point of view as management.
So I'll step in, Brendan. I mean, the chat's been quiet, so and hopefully everybody's still awake because I know sometimes Gap, crawling through financial statement guidance and accounting jargon can be a little dry at times, and I feel like as a profession, us in public accounting, between this 842 and revenue recognition, ASC 606 we had a few years back, we've probably added 4 to 5 pages to financial statement disclosures, and so all in the spirit of being more transparent. But it's been a heavy lift for the profession and certainly for companies internally, their teams, and adopting this standard. I had just a couple questions, and certainly if anyone else on the line wants to submit a question, feel free to do that. I think we've got plenty of time here. But a couple questions, Daryl and Brendan, for y'all. The first one, I mean, we mentioned earlier, you guys mentioned earlier in the presentation, the need to communicate and kind of make sure you're keeping external stakeholders in the loop on how this standard is going to impact your financial statements, whether that's a lender who's looking at certain debt ratio, financial ratios for covenant purposes. Daryl, you mentioned bonding, and I know obviously you do a lot. All of the guys on this call really focus on construction as their primary industry, but certainly 842 is applicable to everybody. But specific to lenders, what are you guys seeing in terms of as of late? How, in your opinion, how educated are the banks on this new standard, and what are you seeing as certain credit facilities come up for renewal, and companies are talking through that process? How is that language being structured, and what's your overall feel for I guess how well the banking industry and lending industry understands 842?
I will say it depends, but probably more in the camp of don't understand it than understand it, especially when you're dealing with. No, look, I think there's plenty of folks at the bank, specifically the ones who are doing the underwriting and some of that I think they have a decent handle on this. But your client facing bankers who are out selling business, who are representing their clients to the underwriters, I think they've struggled with it some. we've done this presentation now for a couple of different banks in and around the Atlanta area. Some of them hadn't even started looking at it as of last fall. Some, a few had thought about it, but I mean, I don't want to say that it's caught a lot of people by surprise, but I think it's caught a lot of the bankers by surprise. We've had some situations where, somebody's close on a debt covenant, and because of 842, they're failing the debt covenant, and they go back to their bank and say, okay, do we include or exclude 842? And they say, well, hey, the covenant's written that you have to include it. So now we're in a situation where the bank has basically said, the bank has said that it's that they're failing a covenant. They've got to go back and renegotiate the covenant. Some banks had kicked around the idea of, as they're putting some of these language in the covenants, putting in the current GAAP or US GAAP as of the day that it was signed, or maybe they're offering some sort of amendment that says, we're using GAAP the day it was assigned, and so you're not having to go in and factor in the liability side. The other thing that I didn't mention earlier, but looking at how you're borrowing, if you've got a facility, a credit facility that has a borrowing base, how that's calculated. A lot of the borrowing bases I've seen historically include like rental payments in that, but if they don't, now you've got a liability that's showing up on the balance sheet that wasn't there. That could affect your ability to access that credit or how much credit you can get. So this certainly can impact your banking relationships. And unfortunately, like I said, I think some of the client servers in the banks aren't as educated on it as they should be, just because they're the ones who are kind of going between, the operating companies and the underwriters. And
yeah,
that's I feel like that's what I've seen mainly.
Yeah, I'd probably echo that on my side of the fence too. I mean, I think the key is don't rely on the banks to volunteer to restructure language in your line of credit or whatever credit facilities are out there. Be proactive and educate. Showing them. Even doing some. I think we've helped some clients do some financial modeling on a pre and post 842 implementation basis, to use that to take to their lenders and help explain or try to help them visualize how this is going to impact the financials. Because the reality is, there may not have been any economic change in the business, things going great, but certainly geography on the financial statements is changing now. And so I think having that to put in front of them has been beneficial for several of our clients, just to be proactive in negotiating, changes to certain debt covenants if that's needed, before that renewal term comes up, versus having to deal with it, after everything's memorialized.
And I think too, one thing to think about is you might be sitting here going, well, hey, I've got this lease. It's fairly low rental payment, like a annual rental payment is immaterial. So I don't want to put it on the balance sheet because it's going to impact my covenants, whatever, or it could. But you've got a 30-year lease term on this thing. And so it's like all of a sudden you could have what's a relatively minor annual lease really, quote unquote, blow up your balance sheet, and you're putting on these massive assets and liabilities that you historically hadn't had, just because the lease term is so long. So I think that's something to be careful of. Looks like we've got a question in the chat. What if the option period renews at fair market value at the time, not a stated rate? You have to be careful here, but I really like this. I really like this thought process here of, okay, we're going to renew at a fair market value. If you have a renewal that's tied to like an index, what is it, CPI index is a pretty popular one. You think sometimes like it's going to renew at the same rate plus a CPI, plus whatever the increase in CPI has been from year to year. If you can tie it to an index, you have to estimate it. If you can't tie it to an index, then you're in a situation where, really there's no way for you to even judgmentally factor out how long you're going to go. Or what that rate's going to be. So there's no way for you to really model that into your financial statement. So I personally, I like that if you're trying to reduce the impact that it has on your financial statements.
So I mean, to be clear, if you say you have a 5-year lease, non-cancelable period of initial 5 years, stated rates, and then at the conclusion of that period, there's another 5-year renewal where the agreement just refers to, the rates will be based on fair market value at the time. Seems like you would not factor that secondary 5-year renewal option into the calculation of the ROU asset or lease liability because it's not estimable.
Yep.
Based on the payment piece. So that was a really good question. Yeah, that has come up several times as with our clients as we're evaluating the impact and have been going through implementation.
And I think Stephen, I think this points back to the private company alternative that we talked about having, if you've got this situation with a related, entity under common control, being able to kind of, it's giving you more control over how you structure those leases if you've got something written.
Yes.
And I'll add on to that. The question is, all right, what do you do at the time? We get to the end of the 5 years. What do we do? Well, you would just, if you end up renewing, you would just account for it as a modification. All right. And so you get to the end of the initial term. You were never reasonably certain to exercise the renewal because you didn't know what fair market value would be. Well, now you get to the end of the term, you renegotiate, you do an amendment. Now you've got stated rates at fair market value. You would just remeasure the lease liability at that time as a modification. Again, you would not need to go back and reassess any accounting that you did at lease inception, if that makes sense.
Yeah. So you almost treat it at that point as a separate contract, as a new lease. So that was a good question. I mean, and Brendan, you started going into this, but this presentation's been largely focused on kind of the day one accounting and but as we're further and further out from adoption, how do companies need to start looking at and evaluating their leases for modifications? How do you determine, whether you have a lease modification, whether that does impact, the change in accounting for the original contract or original ROU asset and lease liability, or, what would trigger you to account for that as a separate contract, if that makes sense. Can you guys speak to that a little bit?
Yeah, I've got an example that from one of my clients recently. So they've done some renovations, or they will be doing some renovations, but they've expanded their space. So they had a lease agreement for X amount of space. Now they have executed, we'll call it an amendment, okay, to lease additional space. Okay, well, depending on the facts and circumstances, you may have a modification or you may have a new lease. Okay. What 842 says, if that expansion space, if the incremental increase in the payments for the expansion space would approximate the fair market value of that expansion space, 842 says really that's not a modification. That sounds like a new contract. Okay. And so that's an area that I imagine would likely be applicable where you did a lease, but now 5 years down the road, 5 years down the road, lease term's 10 years. So you're kind of in the middle of your initial lease. You're like, you need more space. So you go to the lessor, and assuming the space is available, you execute an amendment. Well, that amendment, depending on circumstance, could be a modification, could be a new contract. And so it's all about the incremental increase in the payments as compared to the incremental space. Now you get into the question of, well, how do I determine the fair market value of the expansion space? Well, I'd argue that could take some judgment, because the increase in the payments may not approximate it. But one thing to just think through and talk through with your CPAs if you get to that, if you get into one of those scenarios. You see anything else, Daryl, lately?
No, I mean, I see a lot of turnover with, if you've got like a fleet and you're trading in trucks, especially before their term runs out, that can just create some complications. Seen a lot of some businesses that historically they maybe bought their fleet, they maybe bought any trucks they needed. During COVID, they couldn't get them, but they could get a fleet agreement with Enterprise. And so it's just requiring more tracking than anything. And if if you're selling off a truck, you would still create, whether you're selling it or turning it in, trading it in, whatever it might be, you're gonna end up with a gain or loss. You're doing that before the lease term is out, or even if the lease term is out and you're getting cash, or you're getting some value on trading in. So just something to think about. Impacts the accounting department more than others, I think, just having to track all that stuff.
Very good. I have not, if anyone else has any other questions, we had that good one come through on the fair market value pricing, but any other questions? We do have a few more minutes. If not, and something pops in your head after this presentation, absolutely feel free to reach out to us here at Moore Colson. I think we've got Daryl and Brendan's contact information at the beginning of the presentation. So would love to hear from you guys, get your feedback on this, as well as questions you're running into, and available to help out any way we can. So, but we certainly appreciate you sticking it out with us, and Katie, greatly appreciate the partnership with Sterling and the opportunity to come talk about leases with y'all.
Sure, and thank you so much for doing this program for us. I know you guys already mentioned this, but I'll send a copy of the presentation and the program recording once it is ready. And our next SSP webinar is on September 21st at 3 p.m. It's going to be on qualified medical child support orders. This is part of our employee benefits compliance series. But thanks again for joining us, and feel free to send your feedback and program suggestions to me, Katie Kalmahaiva, and have a wonderful day.
Thanks, everybody.
Bye. Thank you.
Thanks, everyone.
Thank you.